Hey traders and investors, it's George Berger here. Today we're going to look at the utilities. I got a lot of questions last week actually and early this week about the utilities, whether this is time to flock to the utilities because of the risk off moment, and the answer is no. There's a common misconception out there that the utilities and other defensive stocks like the consumer discretionary things are something that you need to buy or put money into and away from the more cyclical things during market downturns. There is some truth to that, but the answer is really, the answer to the question, when do you do that, is it depends. It really depends on the interest rate cycle and where we are general in the economic swings. At the moment, for over the past years, you can see the utilities have risen a lot, obviously with the broader market. But more importantly, the reason why they've risen is because people had been in search for yield. With interest rates going basically nowhere but down, people tried to buy things that had any yield, and utilities tend to have pretty good dividends. In other words, they're good dividend-paying stocks. Now, what's happening? The Fed has become a little bit more hawkish, or at least less dovish. In other words, interest rates are now no longer going down. They may at some point go up, although the timing around that is obviously a little uncertain. So from that point of view, what's happening? People are shifting away from these kind of safety plays and just either going into bonds or literally just going to cash. At least that's the risk aversion trader now. So don't think utilities are a safety play right now. That's more so the case sometimes during secular downturns, but even then it depends. So right now it is not one of those risk off moments where utilities are going to be the best place to hide. From a technical point of view, the XLU, which is the S&P 500 utility sector ETF, looks like it's mean reverting back to where it should, which is the 2009 uptrend. Last week we had some nasty action. The XLU ETF sliced through its 50 and 100-day moving averages. That's yellow and blue respectively, as if they weren't there. And then finally reached a 200-day moving average early this week, and now looks like it's probably immediate term oversold. So that's something potentially that could see a dead cat pounce, but it should move to a lower high. So just because utilities have this defensive nature in terms of at least in terms of the description, doesn't mean right now in a risk-off environment one should be flocking to those kind of stocks. Hope this makes sense. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is StudyTrader, and I'll see you in the next video.